Hey folks, Nick Shaheen here, looking at bonds and rates, specifically the 10-year. It's in the news. On 2/5, we had a good jobs report. Specifically, the area of wage inflation was very good, or at least much better than anticipated, which caused a panic because of the media saying, oh my gosh, the 10-year yield is jumping closer to 3 and the world is going to end at 3. I just wanted to shed some light on this subject. TNX is the ticker that would represent the 10-year yield rate. So this is the opposite of bonds. Bonds, when people say I'm long bonds, they're probably, you can represent it by going long the TLT, which is in the ETF. That just represents the bond itself. In this case, a 20-year. And it's just saying I'm going long bonds. I would be buying calls or buying the ticker itself. So if I'm shorting bonds, I would do the opposite. And the TNX does not have any options, so the TBT would be that. But I rarely trade it. It's not as liquid as the TLT. So today's discussion is just to explain the interaction between the two and how the markets freaked out and how I could have seen it. And indeed, we did see it weeks before this happened. These were the charts that I shared among our group, which showed, okay, we have 3 time frames for the TNX, which represent the 10-year yield. I said we could be making a right shoulder on an inverse head and shoulders, or a regular cup and handle. We're making a handle of sorts, meaning we have higher lows knocking on a roof. This is a daily. And if they break through the roof, the bulls tend to prevail and overshoot higher. Okay, so I said there's a problem with that because typically I thought that increasing rates, we've been fearing the Fed. Oh my gosh, what if they raise rates so quickly? So I shared, okay, so if that's the case, then a shot up here should scare stocks. And indeed, I posted it. I believe I posted it on StockTwits and Twitter that stocks won't like it if this happens. It wasn't clear. It was before this actually breach happened. This is the weekly representation of that same chart, and this is the monthly. So, but my point at the time that I shared was that if this happens, we have a chain of events that would ensue, because the target, the eyeball target, the upside target on the breach of this upside breakout would bring us to another breakout, which could bring us to another breakout, which would yield to about 4%. Just by chasing it technically. So this is the representation a little further out. Okay, so you can see that they're testing a neckline of sorts if I extend it backwards, and a descending lower high trend, which I will show you on the longer term. Oh, there it is right here. So, one begets the other. And this is the last arrow, which is this one here. They're all connected. They're all the same lines that are interconnected on all 3 charts. 3 different time frames from the same ticker, which represents yield. So I said, if this happens, this one right here, stocks won't like it, and that was my statement. So suddenly, weeks later, this happens, or this approaches, and on Friday the 5th, I believe, February, TNX spiked because of markets anticipating, oh my gosh, we had wage inflation. And Yellen, sometimes last year, they couldn't explain how come CPI was stagnant, and they couldn't get their quote target at 2%. Why the rush to 2% target? I don't know, but anyway, that's their job, not mine. So they kind of like shifted things. They said we are probably going to watch wage inflation a little more closely because the CPI has some other things that we can't explain. So they raised wage inflation to add to the at bat, so to speak, and here we are. The one report came out, oh my gosh, she's watching wage inflation, they're going to raise faster. Luckily, this time around, when the new Fed chair spoke, he kind of like re-promoted CPI and saying, okay, wage inflation is whatever, but I'm watching CPI, kind of a deal. That was my interpretation. So now we're back to watching CPI, which is good because that is kind of like stuck in the mud. So I don't think they're going to raise rates as fast as people think they're going to raise rates, especially if oil doesn't spike and stay high, because a lot of the quote inflation is oil. I just bought milk, and it's as cheap as can be at Costco, and same with eggs. So I don't do all the shopping, but yeah, sure, things are a little more expensive, but I don't feel the pinch any more than I did, say, 6 months ago. Okay, so this is the representation of spiking rates and why it's scary. Stocks usually don't like it. And this one moves inversely to bonds. So if rates rise, bonds fall. That's the relationship. So here's another one that could show the same point only from looking at the bonds. So on the other one, we were looking at a breakout in rates. If that happens, then this breakdown happens. And if you see here, I said risk number one on this little guy, which was this guy right there, risk number one. At the same time, I shared the TNX. I also shared this one, and I said this coincides with the story that the TNX is telling chart-wise. Forget what they represent. I said if the other one breaks out, this is breaking down. So if the breakout number one happens on the other one, this is breakdown number one, which leads it to number two, which we'll then talk about number three later. But so again, the same quadrants apply here and there. So here we are. This looks kind of like a head and shoulders of sort. I'm not a technician, but I do know my basics and I use them every day. So regardless of what this is called, this is an attempt for bulls to break out, and they did, and the bears pushed them down to a neckline. Bull says, I can do it again, and they did it a little better. Bears say, I can push you back where you came from. And then bulls say, oh yeah, well, I can do it again. Well, look at how much the bulls did not do compared to the other two, and boom, back to the neckline. So if the neckline breaks, the bull is tired, and the bear will prevail and overshoot down. Ideally, technicians will probably draw a nice clean line with a 0.5, and it's their job because they know it inside and out. And eyeball target downwards is about the middle, so usually all the way down to here. But I usually look left and say most likely they're going to stop here first because this was an area of contention. This was a breakout and support zone, breakout and support, and breakdown and kind of like retaken. So this is a meaningful. So even if the target is down here, I think they'll stop here a little bit. So I draw the line somewhere in the middle of those two. That's my own personal spin on things. But the spirit remains that this is a danger. We're still in it. This is where we are right here. This is where we are right here. If I draw a line, if I just wanted to see, okay, how can we get out of here? So you know, here's an opportunity, regardless of where you draw the line at the tips of the candle itself or the wicks, regardless, that I need to see higher lows, which kind of is happening, maybe lower highs, higher lows, higher highs would be great, but if that doesn't happen, then I see what happens here at the intersection. So the range is getting smaller, it's going to come to a point, and they're going to break out or break down. So it's not imminent that this can happen, and I'll tell you why. Let's look left. It's happened before, and it's happened before. So it's not, but obviously from lower levels, but it's not foretelling doom. It's just saying, okay, that this technical formation could happen. And indeed, if this happens, then chances are this one is happening inversely, meaning we're going to see 3%, 3.25, 3.5, and we shouldn't freak out about it because it is what it is, and the stock market has to live with it. So it's just an adjustment period. So I guess the moral of the lesson here, CNBC and other media outlets, but specifically CNBC, this is not ragging on them, this is just a reality. They're the only gig in town, so to speak, and the most popular gig in town, and it's global, and whatever meme they promote becomes a self-fulfilling prophecy, and they just draw this imaginary line that's going to end the world at 3%. And here we are inches from it, and now we're not worried about it. In fact, we're rallying intraday, if you look tick for tick, with the TNX. So the stock market bounces as the TLT falls and the TNX rises. So make up your mind. Is it bad? Is it good? It doesn't matter. Just go with the fundamentals. So what are the fundamentals? Just look at individual issues. Okay, Apple is near all-time high, but it's still 18 PE. Will it sell how many fewer iPhones? Because the TNX is at 3.5 versus 3. Not many fewer iPhones. Same with Google. Same with Facebook. They have over 1 billion users. How much less money are they making? Because sure, it's going to restrict money flow, but it's not a disaster. I would trade the fundamentals. Another good fundamental set of stocks, which are the financials. They're what, a quarter of the stock market? Let's say 20% of it, one point or another. So they sell at 1 point, 1.5 book, most of them, and most of them are in the teens with regards to PEs. Maybe now a little bit more than before, but recently when I traded them last, by the way, I'm long the financials with some house money, so I'm not exiting them at any point in time here, because I think that, hey, they rise with rates, so they're kind of like a good bet. So this rate fear, it's not as scary as people make it out to be. So headlines are just sentiment, represented here by the VIX or the VXX, whichever. This is the scary chart that everybody's freaking out over. Okay, that's the VXX. So this tells me that it's a sentiment thing because the fundamentals have not changed. Okay, so we might have a little higher rates than we thought by the end of the year or by the end of next year, but the trajectory is still the same. The Fed is still cooperative. The Fed is still sounding like it's going to bail us out or try to or do no harm or do as little harm as possible while doing their job. So they're still pro-economy. They're not against us. And this gentleman here that just took over for Yellen sounds like he's singing the same tune, only he speaks it in plain, simple English a little bit, which, now we're like hanging on at every word they say. Yellen had her first comment. I remember she said something about, 6 months. Somebody asked her about when do you start tapering or raising rates or whatever. She threw out a number and we freaked out at the time. This guy did the same boo-boo, and then the next time he spoke 2 days later, he dialed it back. So trade the fundamentals, or at least I try to trade the fundamentals, and I try to avoid the rhetoric. And sometimes it's tough. But 2 days ago we thought, 2 trading days ago, so on Thursday, we thought the world was going to end. Wednesday and Thursday, we couldn't catch a bid. So here's a 2-hour chart of the S&P minis. So we couldn't catch a bid. We were falling out of control, and suddenly here we are, having a couple of good days when we were supposed to have a bad day. This morning on Monday should have been really bad because we had Italy, which was a new thorn that we didn't think about. We had escalating rhetoric of trade wars, and also dialing it up and tying it to NAFTA. So really leaving NAFTA started to be becoming tangible, or breaking of NAFTA, which also apparently is the end of the world. And we had other things. I can't remember what the heck they were. OPEC, job owning oil. And regardless, so we had a few things. Did I say Italy? Maybe I did. So, and 2 things like Wynn Resorts. Steve Wynn had more allegations than this one of like actual assault. And the stock was down and they couldn't keep it down. It actually flipped green. Same with Boeing. Oh my gosh, tariffs are going to kill Boeing. Are you kidding me, Boeing? So anyway, they have a backlog of 10 years. They shrugged off minus 2.5%, 3%, whatever. Boom, closed up. Walmart shrugged off the sell-up. And these are questionable stocks in the line of fire right now, and the bears couldn't keep them down. So the thesis is the bears are not selling. It's the bulls that are booking profits at the drop of a hat. So the bears have not pressed the short story yet. All right. Nick signing out. If you have any questions, reach out to me. I'm available on email. Let me quickly bring my email here the crude way, sellspreads@gmail.com. So sellspreads@gmail.com. I do answer most emails quickly, all emails quickly, unless I'm driving. So, and I also have a couple of spots open for anybody that wants to learn options.